What is the coinsurance clause? Let's simplify it. Have you ever come across the coinsurance clause in your commercial insurance policy and thought, what does that even mean? Don't worry, we're here to simplify it. Coinsurance is a clause that requires you to insure your property for a minimum percentage of its replacement value or actual cash value, usually 80%, 90%, or 100%. If you don't meet this requirement, you could face a penalty when filing a claim. Here's an easy example. Let's say your building is worth $1 million and your policy has an 80% coinsurance clause. This means you're required to insure the property for at least $800,000. But let's say you only insured it for $500,000. Maybe you were trying to save on premiums. Now imagine you suffer a loss, like a fire, and you file a claim for $100,000. The insurance company will calculate your payout using this formula. What you insured, $500,000. What you should have insured, $800,000, equals 62.5%. Multiply that percentage by your claim amount. 62.5% of $100,000 equals $62,500. The insurance company will only pay $62,500 of your $100,000 claim. The remaining $37,500, that's on you. Why does coinsurance exist? It's there to encourage policyholders to insure their property accurately and share the responsibility of keeping their coverage up to date. How can you avoid penalties? Work with your insurance agent to ensure your property is insured to value. Regularly review your property's value, especially after renovations or improvements. Ask about an agreed value endorsement, which waives the coinsurance clause entirely. Coinsurance doesn't have to be confusing. Now that you know the basics, you can avoid costly mistakes and ensure your business is properly protected. Hit subscribe for more tips on commercial insurance and let us know in the comments if you've ever faced a coinsurance penalty or have questions about your policy. Let's simplify insurance one topic at a time.